Welcome back to Accrued Interest. In today's episode, April 4th, 2025, I'm doing part 2 in my deep dive on Newsmax. But first, a brief disclaimer. The information presented in this podcast is not and should not be construed as investment advice. Investors should make their own decisions regarding the prospects of any company discussed on this podcast. If you're watching this over the weekend, it's been a brutal week. There's been a strong sell-off in the equity markets all around the world on fears about a tariff war breaking out. The Nasdaq, for example, was down over 8% for the last 5 days. That context is helpful because earlier this week in my first video called Is Newsmax a Meme Stock?, I was arguing that Newsmax was overvalued and ripe for a pullback. As of Friday's close, Newsmax had a share price of $45. That is up 170% from where they IPO'd, which is around $10 a share. Today, I want to talk about the fundamentals a little bit deeper. In the last podcast, I explained how I noticed that the broadcasting EBITDA was over 100% of the EBITDA for the whole business. That means that broadcast was doing the heavy lifting to make up for losses in digital. Likewise, I was also troubled by at first glance the digital business was shrinking. What's going on there? You can see from the 10K that the majority of the revenue growth in broadcast came from affiliate fees and not advertising. Let's dig a little deeper using variance analysis. When I talk about variance analysis, I'm going to show you how I break down the financials. There are two things I like to look at in doing a variance analysis. Step one, you want to look at the change from the prior year. And more importantly, and this is the more advanced part we're going to get into today, you want to look at the incremental change, the incremental margins. On your screen, I reproduced the numbers from the 10K and I highlighted in yellow some things that stood out. I'm going to show you how I pull apart the numbers to look for trends. Let's start with advertising. The company grew advertising revenue 1% in 2024 versus 2023. I'm a little troubled that during a major year, we only had 1% growth. The company called out that subscription revenue had grown over $11.5 million. Affiliate fee revenues were up a whopping $25 million year over year. All in all, this led the broadcast segment to have revenue growth of 41% year over year. Here's why I think that is not quite sustainable. The subscription revenue grew so much because Newsmax includes their OTT product that stands for over-the-top television. Their product is called Newsmax Plus. Normally, this sort of streaming service would be included in the digital line. However, I can understand including it with the broadcast line because it's a digital broadcast of effectively their linear channel. The company introduced Newsmax Plus in 2023 in November. So 2024 was the first full year that we had the impact of Newsmax Plus. The growth rate is not going to be as high in 2025. Next, let's look at affiliate fee. The reason why we got the pop in affiliate fees was because of cable companies. Newsmax had a whole lot of affiliate agreements all of a sudden come up for renewal in the same year. This produced a one-time spike that I would argue is not repeatable. I already pointed out how the revenue was up 41%. But what I thought was notable was that the gross margins grew from 38% gross margins in 2023 to 50% gross margins in 2024. The incremental gross margins were 78%. That's because affiliate fee and subscription revenue are almost pure profit for cable companies. Let's look at EBITDA margins. The broadcast EBITDA went from a loss of almost $8 million in 2023 to a positive $20 million in 2024. EBITDA margins went from a negative 8% drag to 15%. That means the incremental revenue that they brought on had an incremental EBITDA margin of 72%. Let's look at the digital segment. It's kind of the problem child. We called out in the last video that the digital revenue was not growing. And it also was not profitable. It turns out the company's OTT product is not included in the digital segment. What Newsmax did, I would argue, is that they put a lot of their lesser inferior businesses into the digital in order to prop up the margins on broadcasts. Advertising for digital was up about 4%. I would expect them to get more page views and higher CPMs. They had subscription revenue down 15%. and product sales were also down 7%. The reason why is because subscription in a digital case includes some of their online magazines and other online paid services. Newsmax also sells supplements, which seems pretty non-core, but it's part of their business. The EBITDA for the digital went from a negative $2.7 million in 2023 to negative $9.5 million in 2024. The reason why was because while the revenue was down year over year, the G&A, that's the overhead, was actually up 23%. What I suspect is that the company put some of their back office costs that they didn't want to include in the broadcast segment into the digital segment. That way, they could brag about how well the broadcast was doing. Bringing it together, these are the remaining questions I have for 2025. What is the appropriate normalized growth rate to use for the broadcast and digital business in an off-cycle year? Next, I want to know what would it take to stem the losses in the digital segment? And lastly, I want to know what are normalized broadcast margins. We'll do that scenario analysis in the future episode, but I want to give you a sense of how I break down a company's financials to understand what questions to ask. As always, thank you for watching. Don't forget to like and subscribe to this channel. Stay tuned for more videos about Newsmax and other companies this Q1 earnings season.